Welcome back to the Deep Dive. We're here to take those sometimes pretty complex subjects and really break them down for you. Today, we're putting together more pieces of that, well, let's call it an intricate puzzle, the alternative minimum tax, or AMT. This is part two of our five-part look into this really significant chunk of tax law. And our mission today is to get under the hood of its adjustments and preferences. These can be kind of surprising. Now, I know it sounds maybe a bit dense, but honestly, getting these details can light up your whole financial picture. We've even got a pretty fascinating real-world story to share later on. Okay, but before we dive deeper, just a quick reminder. This deep dive is based on material from Farhat lectures. All the content, examples, explanations, everything we talk about here is derived from the comprehensive accounting resources over at farhatlectures.com. So whether you're an accounting student, maybe studying for the CPA exam, or you're already a professional, you should check out the website. They've got additional practice questions, video lectures, detailed support. Great stuff to reinforce today's topic.
And a special thanks to Professor Farhat for providing all this valuable material for us to explore. Okay, let's unpack this then. Before we jump into the new stuff for today, maybe for anyone who missed our last deep dive or just needs a quick, refresher, could you give us that lightning fast overview of what AMT is and why it even exists?
Absolutely. Yeah. Think of the alternative minimum tax, maybe like a safety net for the tax system. It's sort of a parallel tax calculation. And it's designed basically to make sure that even if taxpayers use a whole bunch of deductions or exclusions in the regular tax system, well, they still pay at least a minimum amount of tax.
Okay. Well, minimum floors.
Exactly. The journey starts with your regular taxable income. Then to that, we add back certain items. We call these adjustments and preferences.
Mm.
Once we get that total, we subtract an AMT exemption amount, and we'll definitely dig into that exemption in our next deep dive.
Right.
And that gives you your alternative minimum taxable income, or AMTI. Then you apply these special AMT tax rates, usually 26% or 28%, to get your tentative AMT.
Tentative AMT, right.
And the really crucial step is the comparison. You figure out your regular tax, then you figure out this tentative AMT, whichever one is higher. That's basically what you owe. So if your tentative AMT is, say, $5,000 more than your regular tax calculation, you pay that extra $5,000 as AMT.
Gotcha.
In our last session, we started a running example, remember. We began with a regular taxable income of $154,650. And we started adding things back, like deducted state and local taxes, some depreciation differences. Today, we're just layering in more of these specific items.
Right. So AMT is kind of like this counterbalance, isn't it? It claws back certain tax benefits you might get under the regular rules.
Yeah.
Okay, so building on that foundation, let's tackle some more adjustments. One that always seems to jump out and honestly causes a lot of confusion is incentive stock options, ISOs. This seems like a perfect example of where AMT can really catch people, off guard. Can you walk us through what they are and how they fit into this AMT picture?
You're absolutely right. ISOs are a huge one, especially for folks working at growing companies, tech companies, that sort of thing. So incentive stock options are essentially a way for companies to motivate, compensate, and importantly, retain employees. They give an employee the option to buy company shares at a specific preset price. Let's call that the exercise price. And they get a certain period to do it. The big hope, of course, is that the market price of the stock climbs way above that exercise price. That makes the options really valuable.
Right, the potential upside.
Exactly. Imagine you work for, tech company. Stock's at $350. They might grant you options to buy shares at $400, maybe give you 5 years to exercise them. If in 5 years that stock hits $600, well, you can buy it at $400, and if you want, immediately sell it for a $200 per share profit. It's a powerful tool, definitely aligns employee interests with the company's success.
Okay, makes sense.
Now, here's the key part for regular tax. The wonderful thing is, you generally recognize zero income when you just exercise those options. You buy the stock, but no tax yet.
Deferral.
A huge deferral benefit, but this is exactly where AMT comes in and says, hold on a second. For AMT purposes, it's different. When you exercise an ISO for AMT, you have a positive adjustment.
Yeah.
And that adjustment equals the fair market value, the FMV of the stock on the day you exercise, minus the amount you actually paid for the option, your exercise price.
Well, okay, hang on. Let me make sure I'm following this. So for regular tax, I exercise, I buy the stock, nothing happens on my tax return yet.
Yeah.
But for AMT, just the act of exercising, not even selling the stock, creates taxable income right then and there.
Precisely. You nailed it. Let's use Adam's example from the source material. That makes it really clear. Adam exercises options for 10,000 shares. His exercise price is $13 per share. Okay?
Great.
On the day he does this, the fair market value of those shares is $18 per share. So for AMT, we calculate the difference. FMV, $18, minus the exercise price, $13. That's $5 per share.
Right, $5 difference.
So for Adam, that's a $50,000 positive adjustment for AMT. $5 per share times 10,000 shares. And the absolutely critical point, just like you said, is that the AMT sees this as taxable profit, even though Adam hasn't sold the shares. He just owns them now. But for AMT, it's like he's already made a gain.
That sounds, well, frankly, brutal. You're taxed on income you haven't actually received in cash. It's phantom income. Did you actually see this happen to people?
Oh, absolutely. And yes, brutal is the right word sometimes. Back in the late 90s, early 2000s, I worked at Merrill Lynch, specifically in the stock option department. And we saw this exact scenario play out again and again. You'd have executives from big companies. I remember folks from Intel, Tyco, PepsiCo, places like that. They'd exercise their ISOs just like Adam. They'd have this massive paper gain, right? Based on the stock price that day, and they'd have to pay significant AMT on that paper profit. The dot-com bubble burst. Or just the market tanked for their specific stock, and the stock price would plummet. Often it fell below their original exercise price. So think about it. They paid substantial taxes, real cash taxes, on income they never actually realized. The value just evaporated before they could sell for a gain. It was a really tough lesson for a lot of people, really highlighted how risky those paper gains can be.
That's incredible. So people pay tax on money they never actually saw. Is there any way to get that tax back if the stock never recovers? Or is it just gone? And how does this whole thing affect the basis of the stock later on?
Great questions. And that's where this idea of having two bases comes into play. It gets a bit tricky. For regular tax, your basis in the stock is just what you paid for it. In Adam's case, $13 per share. Simple enough. But for AMT, remember, you already paid tax on that $5 per share difference. $18 FMV, $13 exercise price. So your AMT basis gets stepped up. It becomes $18 per share. And this difference is really important when you eventually do sell the stock. For regular tax, you'll have a larger capital gain because your basis, $13, was lower.
A bigger difference between selling price and basis.
Exactly. But for AMT purposes, your gain will be smaller because your basis, $18, was higher. It reflects the fact that AMT already taxed that initial paper gain. Now, about getting the tax back, there's often an AMT credit generated by adjustments like ISOs. This credit can be used in future years to offset your regular tax liability.
Oh, so there's a potential recovery mechanism.
There is, but, and it's a big but, as
Right.
you sort of implied. If the stock tanks and you end up selling at a loss or for much less than hoped, that credit might not fully make you whole for the AMT you paid upfront on phantom gains. It doesn't help much if the stock value just disappears before you can actually use the credit effectively.
So the credit helps smooth things out over time, maybe, but it's not an immediate fix if the market turns against you right after exercising. That's a critical point for planning. Okay, the ISO situation really drives home how AMT can hit you on paper profits and demand real cash. But what about businesses, especially those involved in, say, long-term projects? Does AMT care about how they recognize income, or is it mostly focused on individuals and investments?
Oh, it absolutely cares. Now, it's true that corporate AMT was largely repealed by tax reform a few years back.
Right, I remember that.
But this specific adjustment for long-term contracts still applies to individuals. Think about partners in a partnership or shareholders in an S corporation if that business engages in long-term contracts like construction or development. For regular tax, these businesses often have a choice. They might use the completed contract method.
Completed contract, meaning you wait until the whole job is done.
Exactly. You don't recognize any income or related costs generally until the entire contract is finished. It's a great deferral strategy. Helps with cash flow, right? You report the profit all at once at the end.
Makes sense.
However, for AMT purposes, there's no choice. Taxpayers must use the percentage of completion method, or POC. Under POC, you have to recognize income gradually as the work progresses. You figure out what percentage of the contract you completed during the year, and you recognize that percentage of the total expected profit.
So AMT forces you to recognize income sooner.
Precisely. The AMT adjustment for long-term contracts is simply the difference between the income you recognize under POC, for AMT, and the income you recognize under the completed contract method for regular tax. And what's interesting here is that this adjustment can swing both ways. It can be positive in the early years of a contract, but negative in the final year.
Oh, okay. How does that work? A negative adjustment is good, right? Reduces AMT income.
Exactly. A negative adjustment is favorable. Let's use a quick example. Say you have a 4-year project. Total contract price is $100,000. Let's assume for simplicity you complete exactly 25% each year.
Okay, $25,000 worth of work each year.
Right. So for AMT, using percentage of completion, you'd recognize $25,000 of income in year 1, year 2, year 3, and year 4. Nice and steady. But for regular tax, if you're using completed contract, you report 0 income in years 1, 2, and 3. Then boom, you report the full $100,000 in year 4 when it's done.
Big difference in timing.
Huge difference. So look at the adjustments. In years 1, 2, and 3, AMT reports $25K, regular reports $0. So you have a positive adjustment of $25,000 each of those years for AMT.
Adding income for AMT.
Right. Then in year 4, regular tax reports the big $100,000. But AMT only needs to report the last $25,000 because it already reported $75,000, 25K by 3, in the prior years. So in year 4, regular tax income is much higher than AMT income, 25K. This creates a negative adjustment of $75,000. $100 regular 25K AMT is $75K difference, but since regular is higher, it's negative for AMT calculation.
Ah, I see. It reverses in the final year.
Exactly. Over the 4 years, the total income is the same, $100,000 for both systems. But like you said, AMT just makes you recognize it and potentially pay tax on it sooner. The government wants its money a bit earlier.
Yeah, that seems to be the theme. It's all about accelerating that tax payment. Okay, so we've seen AMT look at income you might make, ISO says, income you will make over time, contracts. Does it also mess with how you deduct certain expenses? Like you mentioned circulation expenditures. That sounds super specific. What are those, and how does AMT treat them differently?
It is pretty specific, yeah. Circulation expenditures are basically costs incurred by publishers, newspapers, magazines, periodicals to establish, maintain, or increase their circulation. Think marketing campaigns, efforts to get more subscribers, stuff like that.
Okay, cost to build readership.
Exactly. Now, for regular tax, the rule is generally quite taxpayer-friendly. You can usually expense these costs, meaning deduct the full amount in the year you incur them. Immediate deduction reduces your taxable income right away.
Which businesses usually like.
Absolutely. But again, AMT has a different idea. For AMT, you must amortize these expenditures over 3 years.
Amortize. So spread the deduction out.
Right. You can only deduct 1/3 of the cost in the year you spend it, 1/3 in the second year, and the final third in the third year. Let's use a $90,000 example from the source. In year 1, for regular tax, you deduct the whole $90,000. Nice. But for AMT, you can only deduct $30,000. $90,000 divided by 3.
Ah, okay. So the AMT deduction is much smaller in year 1.
Much smaller. This creates a positive AMT adjustment of $60,000 in year 1. 90K regular, 30K AMT deduction equals 60K difference added back to AMT income. Wait, let me rephrase that. The regular tax deduction is larger, meaning regular taxable income is lower. AMT allows less deduction, so AMTI is higher relative to regular taxable income due to this item. The adjustment itself reflects a difference in the deduction amount. You add back the excess regular tax deduction compared to the AMT deduction. So 90K minus 30K is added back for AMT calculation in year 1.
Got it. So you add back the $60,000 difference because regular tax got a bigger deduction.
Precisely. Then, in years 2 and 3, AMT gets to deduct another $30,000 each year, but regular tax already took the whole deduction back in year 1, so it has $0 deduction for this item in years 2 and 3. This means in years 2 and 3, you'll have negative adjustments of $30,000 each year because AMT is getting a deduction that regular tax isn't.
Okay, so again, it all nets out over the 3 years,
Yeah.
but the timing is shifted forward for AMT, reducing the benefit in year 1.
Exactly. Understanding these timing differences for both revenue and expenses is just fundamental to navigating the whole AMT system.
It really seems to be. Okay, we've covered some big adjustments, ISOs, long-term contracts, circulation costs, and these can be positive or negative, shifting income or deductions between years. Now let's switch gears slightly to preferences. The source material, and you mentioned this earlier, notes that preferences are always added back for AMT. Why that difference? Why are these always additions?
That's a really key distinction to make. Unlike adjustments, which reflect timing differences and can go both ways, preferences always increase your alternative minimum taxable income. There are always add-backs. The reason goes back to their basic nature. Preferences represent specific deductions or ways of excluding income that provide, let's say, substantial tax benefits under the regular tax code. Think of them as special incentives or bonuses Congress put into the regular tax law, maybe to encourage certain types of investments or activity.
Like extra good deductions or exclusions.
Exactly. The philosophy behind AMT is, look, if you're benefiting significantly from these special preference items and they're potentially lowering your regular tax bill by a lot, then AMT steps in. It effectively takes away or claws back that specific preference item just for the purpose of calculating the AMT. It ensures that those big benefits don't let you avoid paying that minimum level of tax.
Okay, so they target specific, advantageous regular tax rules. What are some examples?
A classic one is interest from private activity bonds. These are a bit different from typical municipal bonds. They might be issued by a private company, but they're sponsored by a state or local government, maybe for something like building a sports stadium or an industrial park. For regular tax, the interest income from these bonds might still be treated as tax-exempt, like interest from regular muni bonds.
So tax-free income normally.
Normally, yes. But for AMT, that tax-exempt feature is taken away. The interest income you receive from those private activity bonds, it gets added back to your income for the AMT calculation. It's no longer tax-exempt in the world of AMT.
Wow, okay. That's a direct hit. What else?
Another one is the percentage depletion deduction. This mostly applies to oil, gas, and mineral extraction industries. For regular tax, percentage depletion can sometimes allow a deduction that's actually greater than the taxpayer's cost basis in the property. It's calculated based on a percentage of the revenue from the property.
So you could deduct more than it cost you.
Potentially, yes. That excess amount, the deduction claimed over and above the actual cost basis, is considered a preference item. For AMT, that excess depletion amount gets added back to your income. And the source also mentions accelerated depreciation on property placed in service before 1987. This was a timing difference, but because those assets are so old now...
They'd be fully depreciated anyway.
Right. It's really not relevant for current tax years, but it fits the historical pattern of AMT targeting accelerated deductions as preferences back in the day.
Okay, so preferences are like specific tax perks that AMT just says, nope, not counting that for its calculation.
Yeah.
It feels like this constant tension, doesn't it? Regular tax trying to incentivize things, AMT trying to ensure a minimum payment.
Yeah.
So if we pull back and look at the big picture again, how do all these adjustments, we talked about the ISOs, the contracts, circulation costs, and these preferences like the bonds and depletion, how do they all come together in the calculation? What's the next step once we've added and subtracted all this stuff?
Yeah, it is definitely a push and pull system. So bringing it all together, you start with your regular taxable income. Then if you took the standard deduction for regular tax, you add that back for AMT, since AMT has its own exemption, not the standard deduction. Then you layer in all these adjustments, the positive adjustment from ISO exercises, the positive or negative adjustments from long-term contracts, the timing difference from circulation costs, and others we haven't even covered today. And finally, you add in any preference items, the private activity bond interest, the excess depletion, etc. All those additions and subtractions get you to a key number, your alternative minimum taxable income, or AMTI, but before you factor in the AMT exemption. In that running example we've been sort of referencing, after accounting for all these items we've discussed today, and in the last session, the calculated AMTI reached $217,248.
Okay, $217,248. That's the base before the exemption.
Exactly. And this whole calculation, all these lines for adding this back, subtracting that, it's all laid out on Form 6251. That's the official IRS form for the alternative minimum tax. You'll literally see lines for ISO adjustments, for contract adjustments, for preferences. It guides you through summing it all up to get that AMTI number. And once you have that AMTI, the very next step, and this is what we'll tackle in part 3, is subtracting the AMT exemption amount. That gets you to the final base amount that the AMT rates actually get applied to.
This has been, wow, a really deep dive into these adjustments and preferences. It's so much clearer now how AAT operates by, second-guessing certain parts of the regular tax system. It takes things that look like a good deal for regular tax, a deduction, an exclusion, deferred income, and says, well, for AMT purposes, we're adding that back or changing the timing. It's definitely complex, but understanding these pieces really does give you a much clearer view of your total tax situation. It feels like you could avoid some nasty surprises this way. You know, this brings up a really interesting question for me. Thinking about how AMT works, especially with things like those incentive stock options, where you might pay real tax on gains you haven't even realized in cash yet. How might that uncertainty affect, say, financial planning for individuals? Or maybe even how companies decide to structure their compensation packages, knowing AMT is lurking out there. It's definitely something to chew on until our next deep dive. Well, thank you for joining us on this part of the journey through the alternative minimum tax. We really hope this session helped you get a better handle on this pretty intricate topic. And as always, if you want to go even deeper, maybe work through more examples or see video explanations, check out farhatlectures.com. They've got tons of resources. And again, our sincere thanks to Professor Farhat for the excellent material that made this discussion possible. We'll be back soon with part 3, where we'll tackle that AMT exemption. Until then, keep digging.